Hello and welcome. Have you ever stared at your payslip or maybe your business profits and just wondered, where on earth does all that money actually go? Yeah, it's a question pretty much all of us ask. Well, today we're going to pull back the curtain on how UK tax is calculated. We'll give you a really clear, straightforward guide for 2026. And look, to make sure we get this absolutely spot on, this whole breakdown has been put together by the experts over at ProTax Accountant. Honestly, these guys live and breathe this stuff. They've helped us take what can be a super complex topic and turn it into something we can all actually get our heads around and use. All right, let's kick things off with a pretty wild fact. Did you know that here in the UK, over £2 billion is paid in tax every single day? I mean, that is just a mind-boggling figure, isn't it? It's what funds everything from our roads to our hospitals. But it definitely makes you think, out of that absolutely enormous daily pot, how is your personal share actually worked out? That is the big question we're tackling today. And we're not just going to throw numbers at you, we're going to look at the why behind them so you can feel way more in control of your own money. So here's what we've got lined up. First, we'll cover the basics of UK tax. Then we'll dive into how it all works if you're on a payroll. After that, we'll switch gears and look at the world of the self-employed. From there, we'll get into the often misunderstood inheritance tax, wrap everything up with the key numbers you need for 2026, and finally point you in the right direction for some expert advice. Sound good? Okay, let's jump right in. Now, when most of us think about tax on what we earn, our minds usually go straight to income tax, right? And yeah, that's a huge part of the picture. But the first thing we're going to break down is the system that runs right alongside it, something called national insurance. It's so important to understand this first because it affects pretty much everyone works. So what exactly is it? Well, here's the key thing. National insurance isn't just another tax that goes into a big pot. It was actually set up as a kind of social security. The contributions you make, people call them NICs, directly build up your right to get certain state benefits. The big one, of course, is the state pension, but it also covers things like employment support and maternity allowance. So it's probably better to think of it less as a tax and more as a contribution to your own future safety net. Now, if you're an employee, the good news is that most of this is taken care of for you. Phew! It's all collected through the pay-as-you-earn system, or PAYE as you'll see it. Your contributions are called Class 1 National Insurance, and your employer just deducts them from your salary automatically, before the money even hits your bank account. But how do they figure out how much to take? Well, it all comes down to these three key thresholds for the 2025/26 tax year. Now, the first one, the lower earnings limit, is actually pretty interesting. If you earn more than £6,500 a year, you stop building up qualifying years for your state pension, even though you're not actually paying a penny in NI yet. Pretty cool. Then, once you cross that primary threshold of £12,570, that's when you start paying. And then, once your earnings get to the upper earnings limit, things change again. And here's how the rates actually work. You'll pay 8% on the slice of your income, that's between that £12,570 and the £50,270 limit. Now here's the bit that might surprise you. For every single pound you earn above that 50,000 mark, the rate drops, way down to just 2%. So why does it do that? Well, it's because national insurance is tied to benefits, and those benefits have a cap. Since there's a limit to what you can claim, there's also a limit on what you contribute. It's a really key difference from income tax, where the rates tend to just keep on climbing. Okay, so that's employees covered, but what if you work for yourself? What if you're a freelancer or a contractor? Well, the system for the self-employed is a little bit different. It involves different classes of national insurance, and yeah, it gives you more control, but it also means a bit more responsibility. Let's take a look at how it works. To make this really clear, let's walk through an example. Let's meet Chloe. She's a fantastic freelance graphic designer. She's based in London, and she's had a really good year. Her business profits, that's her income after she's taken off all her business costs, are a solid £30,000. So how do we figure out her national insurance bill? Okay, it's actually a pretty straightforward calculation. First, you take her total profit, £30,000. Now, just like employees, she gets a tax-free amount. For the self-employed, it's called the lower profits limit, and it's the exact same figure. £12,570. So we subtract that, which leaves her with a taxable profit of $17,430. On that amount, she pays what's known as Class 4 national insurance at a rate of 6%. That works out to £1,045.80 for the whole year, and she'll pay that when she does her annual self-assessment tax return. Right. Now listen up, because here's a great pro tip for anyone who's self-employed. You might have heard of something called Class 2 national insurance. It used to be something you had to pay, but now, for most people, it's voluntary. But paying it can be a really, really smart move. It only costs about £3.50 a week, and get this. Each year you choose to pay it counts as a full qualifying year towards your state pension. When you think that you need about 35 of those years to get the full pension, this is an incredibly cheap way to make sure you don't have any gaps in your record, especially in years where your profits might be a bit lower.
Okay, so we've talked about the tax you pay on what you earn while you're working, but definitely stay with me here because this next part is absolutely crucial for any long-term planning. And it's a topic that a lot of people are, well, surprisingly unsure about. We're going to shift gears and talk about the tax that can apply to your estate after you're gone, inheritance tax.
I know, I know. It's a topic a lot of us would rather not think about. But honestly, just understanding the basics is the first, most important step to planning properly for your family's future. So what is inheritance tax, or IHT as you'll often hear it called? And maybe even more importantly, when does it actually kick in? So before we can even talk about the tax, we need to know what's actually being taxed. We need to define what an estate is. And it's actually quite simple. It's the total value of everything you own when you pass away. We're talking your home, your savings, any investments, cars, even valuable things like jewelry or art. Now, from that total, you subtract any debts you still have, like a mortgage or a loan, and what's left over is the final value of the estate. Okay, here comes probably the most important number to remember in this whole section. Everyone in the UK gets a standard tax-free threshold. The official name for it is the nil rate band. For the 2026 tax year, that amount is £325,000. What that means, simply, is that in most situations, the first 325 grand of an estate is completely 100% free from inheritance tax. So the obvious question is, what happens to any part of the estate's value that goes above that tax-free amount? Well, that's where this number comes into play. The main rate for inheritance tax is a flat 40%. Yep, 40%. It's a really significant chunk, which is exactly why getting your head around the rules and the exemptions is so important if you want to do any effective planning. But it's not always as simple as just paying 40% on everything over that limit. Far from it. There are some really powerful exemptions you need to know about. For example, anything you leave to your husband, wife, or civil partner is completely exempt. They can even inherit any of your unused tax-free allowance, which is huge. Donations to qualifying charities are also exempt. And then there's the big one you hear about, the 7-year rule for gifts you make while you're still alive. Basically, if you live for 7 years after you give a gift, it generally falls outside of your estate for tax purposes. That's a real cornerstone of good IHT planning. Wow, okay, we've covered a lot of ground there, and I know we've thrown a lot of numbers at you. So let's just take a breath and pull all the most important figures together into one simple summary. Honestly, if you remember just one thing from this whole discussion, make it the numbers we're about to show you. Think of this as your essential cheat sheet. For national insurance, that magic number where you start to pay is £12,570, and that's the same whether you're employed or self-employed. The main NI rate you'll pay on your profits if you're self-employed is 6%. Then, switching over to inheritance tax. The two big figures to remember are that £325,000 tax-free band and that hefty 40% rate on anything above it. These are really the fundamental numbers you need for 2026. And that brings us to our final point. And you know what? It's probably the most important one of all. While this whole guide gives you a really solid foundation, tax is so personal. Your specific circumstances, your goals for the future, your family situation, all of these things will change what the right strategy is for you. And that's exactly why getting professional, tailored advice is just non-negotiable. So it's really important for us to be clear about this. All the information we've shared today is for general guidance. It's to help you understand things better, to educate. It's designed to give you a bit more clarity and confidence, but you should never, ever use it as the only reason for making a financial decision. Before you do anything, you absolutely must speak to a qualified professional who can look at your specific situation.
And for that exact professional guidance, why not speak directly with the experts who put this whole guide together? To get advice that's personalized for you, whether it's about your job, your business, or planning for the future, get in touch with ProTax Accountant. You can reach them directly on WhatsApp or by phone at 07985 689912, or you can just send them an email. And hey, for more clear, helpful content just like this, make sure you hit subscribe on their YouTube channel. Thanks so much for joining us.